Hello, everyone, and welcome to this webinar titled Insurance Company Investments in Mortgage Loans. My name is Hawker Goodmanson, and I'm a partner in Chicago's Structured Finance Group. Today, you will hear from a number of experts across various practice areas and different offices about a number of legal topics that are highly relevant to insurance company investments in mortgage loans. The agenda today is packed. We're going to start with Steve Kaplan and Holly Bunting talking about understanding and mitigating material mortgage licensing and regulatory risks. Then Larry Hamilton will talk about insurance regulations and risk-based capital considerations. Terry Schiff and I will talk a little bit about some practical applications of the principles that they will speak about. And then Tamim Zanelbai will talk about some aspects of Federal Home Loan Bank financing arrangements. Claire Reagan and Adam Cantor will talk about the role of asset managers, and Eric Riley, Miller Smith, and David Freed will talk about commercial mortgages in particular, where I think a lot of the earlier discussion will be focused on residential mortgage loans. And so without further delay, Steve and Holly, I turn it over to you.
Great, thank you. I am Steve Kaplan. I am in our Washington, D.C. office and a member of our regulatory group focusing on consumer financial services. I'm joined by my partner, Holly Bunting, who I'll let her introduce herself, but she also focuses on consumer regulatory, residential mortgage in particular. So thank you, Hawker. Can we, yep, thanks. One more slide, please. So I'm going to talk about mortgage regulatory related requirements. Holly and I will identify the source of regulatory requirements, when and the type of different requirements that apply, including state licensing and registration requirements. Then we're going to talk a bit about potential consequences, including liability and loan impairment for failing to comply with regulatory and licensing requirements. And then most importantly, we're going to talk about how to control for those risks. Next slide, please. Mortgage lending and mortgage finance is incredibly highly regulated, both at the federal and state level. Requirements are not always black and white, and different participants have different risk tolerance, which makes it interesting. The specific regulatory requirements depend on a lot of different factors, including the nature of the loan. For example, lien priority, open versus closed, which I'll talk about in a moment, loan amount, and other underwriting characteristics. The role of the entity that we're talking about, whether broker, lender, in this case, a holder or purchaser, or a servicer or holder of servicing rights, and then the entity type that either makes or purchases the loan. For example, is it a bank? Is it a non-bank state licensed entity? Is the purchaser a licensed entity? Is it a trust, which we and others will talk about, or is it an insurance company buying the loans directly? Next slide, please. The first and most important characteristic when we're talking about types of loans and the regulatory requirements that follow for those loans is the distinction between qualified mortgages and non-qualified mortgages, QM and non-QM loans. A loan that is a qualified mortgage is one that has a DTI below a certain level, or that is eligible for purchase by the GSEs or the federal agencies. Those loans are deemed to be safer by the federal, by the regulators, by the CFPB and others, and therefore are not subject to as significant of an underwriting ability to repay types of requirements. Non-QM, on the other hand, do not have those characteristics, are not eligible for purchase, and therefore are subject to additional ability to repay requirements, and as, if not more importantly, are subject to enhanced potential damages with respect to raising violations, for example, as a defense to an action to collect the debt or in a foreclosure action. Next slide, please. Another important category that we'll talk a lot about, or that you'll hear a lot about, are higher price mortgage loans, defined under the Federal Truth in Lending Act. Those loans are subject to additional requirements at origination, including escrow-related requirements that survive the loan, and some enhanced damages, but generally people get comfortable with purchasing such higher price mortgage loans. High cost mortgage loans, on the other hand, HOPA loans, have APR or points and fees triggers have that the fees exceed certain established limits. There are also state high cost laws. Those laws generally result in assignee liability, and participating in those loans in certain jurisdictions at the state level will prohibit a company and its affiliates from participating in certain bond or other programs, which basically makes those loans off limits. Next slide, please. Another major, next one again, please. Open and closed-end mortgage loans. I mentioned that a minute ago. With the increase in equity, we see a lot of action in the home equity space, either typical home equity loans or home equity lines of credit, or in some cases, home equity investment products, which we're not going to talk about it as much. But those types of products also trigger various different requirements. So, for example, open-end loans are not subject to the ATR requirements, but what qualifies as a HELOC is not so simple and complicated. Additionally, home equity lines of credit, there are no standardized documents, so documentation varies greatly by originator, and there are express restrictions on the ability to suspend those or terminate lines of credit, which makes it more challenging from a business perspective, from a line management perspective. Next slide, please. So the type of portfolio is really going to be important when you're talking about the types of regulatory requirements that apply, as well as licensing and registration requirements, and how to manage for those risks. So now I'll turn it over to Holly.
All right, thanks, Steve. The mortgage regulatory environment is also an important consideration when we're thinking about mortgage portfolios and the various regulators that have jurisdiction. Next slide, please. It's both at the federal and the state level. So it's not enough to just consider CFPB regulation and authority and enforcement as it relates to mortgages. It's also a state regulated process as well. And of course, it's regulated differently across the various states. So we'll highlight just a few of the agencies, both at the federal and the state level, that have primary authority to regulate mortgage lending. Next slide. The first is the CFPB, and there's a host of laws that the CFPB has responsibility for. You will often hear folks refer to this as the alphabet soup of mortgage regulatory laws, and these were transferred to the CFPB after the Dodd-Frank Act was passed in 2010. I'm not going to go through all of them. There are a lot of different laws that have various implications on mortgage lending. There are a few, though, that I think stick out as primary regulatory structures for mortgages. One being the Equal Credit Opportunity Act, which contains not only prohibitions on discrimination against applicants to mortgage lending, but also contains other disclosure requirements relative to appraisals, as well as the decisioning of mortgage loans. Fair Credit Reporting Act governs a lender or servicer's ability to pull consumers' credit reports and the requirement to have a permissible purpose to do so, as well as invokes duties as to the reporting of consumer information to credit reporting bureaus. There's also Graham-Leach-Bliley, if you could go back one more slide, that relates to privacy. Real Estate Settlement Procedures Act includes anti-kickback provisions as it relates to the relationships and referrals of mortgage business, but also includes extensive regulations as it relates to the servicing of mortgage loans, including default servicing and the various requirements to provide loss mitigation opportunities to consumers There's the Truth in Lending Act, what Steve mentioned, one of the older and more preeminent statutes that relates to mortgage lending, the cost of credit and the disclosures that are required to consumers. It's also a statute that includes assigning liability, so it's one that gets a lot of attention. And then finally, unfair, deceptive, abusive acts or practices. That is particular to the CFPB. It was authority granted to them via the Dodd-Frank Act, and it's a law and an authority that they use quite frequently from an enforcement perspective. Next slide. The CFPB has a broad range of authority. There's supervisory authority over larger depository institutions, as well as non-bank covered persons. So companies that are involved in the origination, brokering, servicing of consumer purpose residential mortgage loans are subject to the supervisory authority of the CFPB. They, of course, have regulatory authority over the list of federal consumer laws that we just mentioned, as well as enforcement authority as it relates to persons who violate those various federal consumer financial laws. Next slide. And their enforcement authority gives them a broad range of remedial authority. That can include everything from consumer remediation, contract rescission, reformation, or restitution orders. They also have civil money penalty authority, which, if you look at the figures on the screen, knowing violations could be over $1 million per violation per day. So it's substantial threat of civil money penalty authority as it relates to violations of the consumer credit laws the CFPB is responsible for enforcing. They have been aggressive as it relates to enforcement, both in the number of actions that they've brought over time, as well as the scope of the parties to whom they have investigated or sought to investigate, and then as well in their interpretation of certain laws. RESPA is a good example where the CFPB took a pretty novel interpretation. In that case, resulted in decision from the DC Circuit as to how that law was interpreted or should be interpreted. So they have certainly demonstrated their willingness to be aggressive as it relates to enforcement. And of course, there have been various proposals to limit the CFPB's authority. I think the most prevalent one now is the Supreme Court heard oral arguments in a case as it relates to the CFPB's funding structure and whether or not that is constitutional. The Supreme Court has previously considered challenges to the structure of the CFPB from the director's perspective and ruled that the president does have authority to remove the director. And then there are always, I think, calls on a consistent basis for Congress to make changes to the structure of the CFPB. So it's certainly an agency that gets a lot of attention and can be a bit controversial. Next slide. Other federal agencies, the Federal Trade Commission, they have authority over the prohibition on unfair and deceptive acts and practices in interstate commerce. This is much broader than the authority the CFPB has, because this certainly affects any consumer product in the interstate commerce. Their enforcement authority, though, is a bit more limited than what you'll see from the CFPB. The Supreme Court ruled in 2021 that the FTC does not have ability to seek monetary relief, such as disgorgement or restitution. They can still seek an injunction and have civil money penalty authorities, but the scope of the authority that the FTC has is much more narrow than the CFPB as it relates to these unfair and deceptive acts or practices. There's also HUD, the U.S. Department of Housing and Urban Development, which has enforcement authority under the Fair Housing Act. And there's also the Department of Justice, which has authority to bring actions as it relates to discrimination claims under ECOA, as well as violations of the Service Member Civil Relief Act, which provides certain protections for service members on active duty. Next slide. Steve?
Okay, thanks, Holly. So Holly talked a lot about the federal regulators. I think the important thing to recognize, everyone is always most concerned, of course, with CFPB because of the significant authority to impose huge fines, monetary fines, over $1 million per day per violation. And from a purchaser perspective, originators, servicers are subject to the supervisory requirements. Violators of the law, including a purchaser, could be subject to that penalty authority, but not supervisory authority generally. Notwithstanding the fact that we talk mostly about the federal regulators and people focus on that, The states have significant authority over mortgage finance. There are 50 different state laws that generally apply, and I'm going to talk a little bit about licensing requirements. Licensing requirements apply to loan originators, lenders, brokers, servicers, and purchasers in certain states. And it applies to not only the holder of the loan, but the law also may apply a licensing requirement to an entity that controls servicing, owns the servicing rights, defined differently across different states. And the states don't necessarily define what it means to hold, take assignment of a loan. Next slide, please. So you're left with these state laws that on their face appear to apply to an entity that purchases a loan. We've made arguments as to the states why they don't have the authority from a dormant commerce clause perspective and other avenues. But generally, the states, although they've eliminated some of their in-state office requirements, still assert jurisdiction over purchasers, even those who do not actually engage in any servicing related activities. That being said, there are exemptions from those licensing requirements based on oftentimes the type of entity, sometimes the loan characteristics. But most importantly, from our perspective, the federal law provides for the preemption of state licensing requirements as applied to federally chartered banks, national banks. Almost all states, if not all states, also include an exemption for a national bank. So later on, folks will talk about use of trust structures in order to argue that a state licensing requirement doesn't apply. Next slide, please. In some cases, folks will get licenses, obviously, to purchase or participate in mortgage finance activities, depending on whether or not they're continuously engaging in business because they're concerned about business interruption, concerned about penalties, or they might limit the jurisdictions in which they do business in. This slide identifies some of the state requirements related to under those licensing laws, including substantive restrictions on loan terms and conditions. But there are significant, and Holly talked more about this, impediments to and requirements related to actually obtaining licenses. Next slide, please. I talked a moment ago, or I referred to the states having enforcement and remedial authority. Like the federal regulators, they do. They can issue C&Ds, cease and desist orders, and they do. They can suspend or revoke licenses and impose fines. Generally, those actions are against originators and servicers for either failing to be licensed or not complying with applicable legal requirements. But we have defended, unfortunately, either purchasers that are either licensed or that believe they're not subject to licensing, but the state believes that the licensing requirement applies based on their role and the underlying relevant documents. Next slide, please. Holly, you.
Thanks, Steve. Next slide. So Steve gave a high-level overview of the types of restrictions that you would find in a state mortgage licensing law. And I want to talk a bit more about some of the practicalities or the challenges and the boxes to check, quite frankly, in order to proceed with state licensing. As Steve mentioned, there are certain states that require licensing merely to purchase first lien residential mortgage loans with or without those servicing rights, and then also to purchase and hold mortgage servicing rights for first lien loans. There are exemptions that are available for insurance companies in some states, but it's certainly an analysis that has to be done on a state-by-state basis. Not every law is the same, and there are vast differences in the way certain states handle licensing in the category of purchasing and holding servicing rights as well as whole loans. Next slide. Processing times for state mortgage licenses also can vary. Most states, I'd say, we're looking at about 60 to 120 days in order for a license to be approved. That, of course, assumes that application has been compiled and submitted in a pristine form, that there's not a lot of back and forth that's needed with a state regulator in order to complete an application. There are, of course, outliers. California can take up to 9 months for a license approval, and then New York can be minimum a year in order to get through and process licensing. So it requires a lot of planning up front and baking those timelines into your process. Next slide. There's other requirements for licensees. Steve touched on some of these, but there may be an in-state office requirement. There are some states that hold true to those brick and mortar locations, even in situations where you may just be a mere purchaser or holder of servicing rights. There also could be restrictions on offshore entities that could relate to the ability of an offshore entity to engage in a licensable activity or to receive consumer information or even provide services as a vendor to a licensed mortgage entity. So again, restrictions that are important when we talk about these businesses. Steve noted the requirement to designate a responsible individual. Usually that's a person that has an individual license that is agreeing to take on responsibility for compliance under the various state laws. And then there's also states that impose criminal background checks and even financial background checks as it relates to a number of individuals who are involved or hold positions of management authority within the licensed entity. Control persons can have a different definition per state, but for the most part, you're looking at individuals that have roles within the organization where they can exert control and management. Direct owners, indirect owners of a business, there's usually a percentage of ownership that applies when you're looking at the checks required for indirect owners, but it's important to sort of track the chain of ownership and be clear about who does and doesn't qualify for those particular checks. And then again, I mentioned officers, certainly branch managers, and then other folks that have responsibility for the day-to-day business of that entity. Next slide. There are some state-specific issues that are relevant to insurance companies when you're thinking about the mortgage licensing process. One of those is that many states require submission of GAAP-compliant audited financial statements with that application. So to the extent that an applicant doesn't have those in their normal course of business, it may be a situation where an entity needs to request a waiver from that particular requirement, or it may be a situation where a state would require some additional steps to be taken in that regard. There's also questions as it relates to insurance regulators and Secretary of States at the state level. In some states, an insurance company that's in the business of purchasing mortgage loans may fall into a bit of a regulatory gray area. And so there'll be some additional questions of qualification, as well as figuring out exactly what box entities may fit into from that licensing perspective. Next slide, please. In addition to the mortgage regulatory agencies that are issuing licenses, there are other state agencies that do have authority and look to enforce mortgage related businesses. One is the Attorney General. They may have authority over a broad consumer protection statutes under unfair deceptive acts and practices or other specific claims. There may be federal statutes that grant state attorney generals explicit authority to enforce. And so they certainly are active as it relates to residential mortgage lending and consumer protection. There's also state agencies that may have authority over anti-discrimination and other statutes that are similar to the Equal Credit Opportunity Act. The prohibited bases under those statutes as it relates to anti-discrimination may be different than what's at the federal level. So again, you may have a situation where those anti-discrimination provisions at both the federal and state level have a different scope and obviously are important in the way that business is conducted. So again, just another state agency that may have authority as well. Next slide.
Okay, so I'm going to talk very quickly, I've got a few minutes left, about pathways to liability and how to control for those risks. Next slide, please. So there are various forms of liability that could apply to a participant or purchaser of residential mortgage loans. Direct liability, there are some requirements that apply to a holder. So for example, a notice requirement under the Federal Truth in Lending Act, the 404 notice requirement needs to be provided. Typically that responsibility would be given to the servicer to do that. Asset impairment. So depending on the product, a violation could impair the underlying asset, could void the loan, could make it rescindable. An example of that would be licensing related requirements in certain jurisdictions, or usury. Usury generally wouldn't apply to first lien residential mortgage loans, but second lien loans are subject to state usury restrictions. So that is a consideration. S&E liability, talked about that earlier. There are certain laws under the Truth in Lending Act, as well as under state high cost and HOPA, federal HOPA, that result in S&E liability. Aiding and abetting, this is the granddaddy. This is where the significant liability could arise. However, in order for a party to be considered to aid and abet a violation of law, there has to be either knowledge under the common law or under Dodd-Frank substantial assistance and reckless disregard of the law. So reckless disregard as opposed to knowledge. Next slide, please. Next slide. So how do you mitigate risk? This is the stuff that, frankly, we do all the time on a daily basis. You want to design a program that tries to limit the applicability of those federal and state laws based on the vehicles and the types of entities that you use. You want to ensure compliance. You want to diligence for requirements, but you only want to look at requirements that you actually care about, because if you look at a requirement and then ignore a violation of law, then you might eliminate or might lose holder in due course status protection. And then finally, you want to consider reputation risk. So things that aren't expressly required, but what are the types of things you worry about the New York Times article? So hopefully that provides a little bit of an understanding of the significant regulatory requirements that apply at the mortgage level. With that, I'm going to turn it over to Larry to talk about insurance.
Thanks very much, Steve. Next slide, please. We are going to talk about the authority of insurance companies to invest in mortgage loans, and then how that is reflected in the statutory accounting and reporting system, and very importantly, the risk-based capital system that insurance companies are subject to. First and foremost, there is a regime that resides in the insurance codes of every state in the United States and the District of Columbia and Territories that governs what investments are authorized investments for insurance companies that are domiciled in that jurisdiction. And these laws are far from uniform, very wide variation among the states. The National Association of Insurance Commissioners, which is a service organization that coordinates and supports the insurance regulatory functions of the states, has developed a model law to govern insurer investments, and it is one of the least adopted model laws that the NAIC has come up with. Only 9 states have adopted it. That said, all states, through their insurance statutes, do permit insurance companies to invest in mortgage loans, but with variations. Some of the variations are: what percentage of the insurance company's assets can be invested in the mortgage asset class? What loan to value ratios are required? And that can vary based on whether the loan is insured or guaranteed, whether it's a purchase money mortgage. There are requirements regarding second lien mortgages, which are often not permitted investments unless the insurance company owns the first lien mortgage. And then a particularly interesting variation is the extent to which the statute addresses the ability of insurance companies to own mortgage loans indirectly. And that's critical because of what we just heard about the use of trusts to perhaps become exempt from licensing requirements for state mortgage licensing. And the NAIC model law is very good in this respect. It says that insurance companies may own loans, obligations secured by a lien on real property, either directly or indirectly through partnerships, through trusts, through limited liability companies, through joint ventures. But in the majority of states, it's actually, the statute is going to be silent on the method of owning directly or indirectly. But now, as we're about to move from the statutes of authorized investments, we're going to talk about the system of statutory accounting, which is what insurance companies use instead of GAAP accounting. And that system, thankfully, is largely uniform across the states because it is an NAIC standard. So next slide, please. And the Statement of Statutory Accounting Principles number 37 is the definitive statement of what counts as a mortgage loan for statutory accounting purposes. And it is defined as a debt obligation that is not a security that is secured by a mortgage on real estate. And then there's a statement that in addition to directly originated mortgages, the definition also includes mortgage loans that are acquired or obtained through an assignment, syndication, or participation. Let's get even more refined. The definition says that a bulk purchase where an insurance company's interest in multiple mortgage loans is separate and divisible legally, and the purchase is facilitating the acquisitions of multiple single mortgage loan agreements, that counts as a mortgage loan under Statement of Statutory Accounting Principles number 37. And a titling trust, in our view, would be an example of a bulk purchase and holding of mortgage loans. By contrast, the SAP number 37 defines something that is not counting as a mortgage loan for statutory accounting purposes, and that is what they call a bundle of mortgage loans with various unrelated borrowers and collateral. And an example of that would be a commingled fund, where an insurance company owns a piece of the fund, an interest in the fund, and the fund owns multiple mortgages and there are other investors. That is not going to be a mortgage loan under statutory accounting. Next slide, please. I'm not suggesting it's not an authorized investment or an admitted asset for the insurance company, just that it wouldn't be classified within this category. So mortgage loans meeting this definition are reported as individual line items on Schedule B. B as in Bravo of an insurance company's statutory investment schedules. And they're reported importantly at the original principal value that then gets amortized over time. Now I'll mention the risk-based capital system, which is also an NAIC uniform establishment, and it is tied to the statutory accounting treatment. So if it is a Schedule B mortgage loan, it is going to take certain risk-based capital factors, which measure, just to put it in a very abbreviated way, the amount of capital that insurance companies need to hold against the investment based on how risky that investment is considered to be under the RBC system. So the gating issue here is whether it's a residential or commercial mortgage, because there are different RBC factors for those, even for Schedule B mortgages. And as we'll hear later in some of the other parts of the presentation, it's not always 100% clear whether a mortgage is residential or commercial, how it's to be classified, but that will come up later in our webinar. So the next two slides are going to show the pre-tax risk-based capital factors for life insurance companies for Schedule B mortgages, broken down as to whether they're residential, commercial, and whether they're insured or guaranteed or not. So next slide, please. Okay, so the lowest RBC charges, not surprisingly, are for insured or guaranteed mortgages. And these apply regardless of whether it's residential or commercial. So as you can see, in 14 basis points of factor for an insured or guaranteed mortgage loan in good standing, that is about as low as you can get other than a US Treasury security investment as investments in an insurance company's portfolio go. And then it gets higher based on a mortgage being not in good standing, one category for being 90 days or more overdue, but not in foreclosure, and the highest for a mortgage in process of foreclosure. And as you can see, it roughly doubles at each of those intervals. For a non-guaranteed or insured mortgage, which I think is where most of the focus goes, that's the right-hand column. And you see that those factors are 68 basis points for a good standing mortgage. Again, roughly doubling when you go more than 90 days overdue. And again, when you go into foreclosure. Next slide, please. Okay, the commercial mortgages, again, these are not insured or guaranteed. And here there is a category, CM1 to CM7, which is based on, it's formulaic, based on two variables, the debt service coverage and the loan to value ratio. And the commercial mortgages, as you can see, they start out at a little higher level than the 68 basis points for a residential mortgage, but still pretty good, 90 basis points for CM1, and then moving up through the ranks. to CM5, which is 7.5%. And then those more serious categories of 90 days or more overdue, 18%, in process of foreclosure, 23%. So quite a range there. Next slide. But I also will observe that if you had a chance to classify a mortgage as residential rather than commercial, the incentive would be to have it be residential, right? At 68 rather than 90 bips. Now, when an insurance company holds an interest in a joint venture or partnership or limited liability company that owns mortgage loans, then those investments are reported as other long-term assets on a different schedule of the statutory financial statements, investment schedules, Schedule BA. And BA is a kind of catch-all and includes a lot of different kinds of investments, not just these types of mortgage loan vehicles, but they're a little different. Remember, Schedule B mortgages were valued at the amortized principal, whereas the Schedule BA mortgage loans that are that underlie one of these joint venture partnership or limited liability companies are going to be valued based on GAAP equity. And I should also observe at this point that if you have this limited liability company, it may be leveraged. And so the GAAP equity of that entity is going to be net of any leverage. So when you look at the factors that are used, RBC factors, for the Schedule BA mortgage loan investments through one of these intermediate entities, also bear in mind that if it's leveraged, that's going to reduce the number that the RBC factor is multiplied by. The multiplicand will be the net figure. So unaffiliated mortgages that are on Schedule BA use the same RBC factors as commercial mortgages. So if there are debt service coverage and LTV covenants and they're complied with, then you use that table of equivalent of to determine the commercial mortgage category. If investments are defeased with government securities, then they get a CM1. Other investments that are comprised primarily of senior mortgages are CM2, and that's going to be normative. That's going to be the most common for Schedule BA mortgages, are going to go into that CM2 with a 175 basis point RBC. And then if they're not senior, if they're mezz or subordinated, they're going to go to CM3 with 3% RBC. And then if the mortgage is an affiliated obligor, that's going to be in a different set of categories. And there's a very complicated RBC worksheet that I would put you to sleep with if I went into it now. So let's move on to the next slide. One other way that insurance companies can get exposure to mortgage loans, and that is if their mortgages are securitized as residential mortgage-backed securities or commercial mortgage-backed securities. And those are treated as, quote, bonds in the NAIC statutory accounting system. Bond is a very broad generic term that the NAIC statutory accounting uses for fixed income securities other than preferred stock. This, as an aside, the definition of what counts as a bond for statutory accounting purposes has recently been rewritten, and there's a whole new principles-based bond definition that we've talked about in other webinars, and be happy to talk more about it in another context. That goes into effect January 1st, 2025. But we're assuming here that the securitized notes are going to be passing the test to be bonds. And they go on a schedule called Schedule D, a delta, and the RBC for Schedule D assets is tied to the credit quality designation. So for mortgage-backed securities, for at least more than a decade now, the NAIC credit quality designation has been assigned through a financial modeling process. For most Schedule D bonds, the credit quality designation is a translation from the NRSRO, external credit rating. So if you were getting an IBM bond or some other type of non-mortgage backed securitization note, it would be tied to the rating agency's rating. And there's a schedule of equivalence so that a 1A is the same as a AAA external rating, et cetera. But MBS are not under that system. They go through a financial modeling process that's overseen by the NAIC and contracted out to external providers. But if it's a senior loan in an MBS structure that sits above the tranche notes, then this would count as a type of investment that would take its risk-based capital charge from the RBC rating. Schedule D assets are carried at amortized cost as long as they rank above the lowest level, which is NAIC 6, which is basically a security that's in default or near default. So just want to mention a little bit of look ahead to 2025 is that MBS structures under the new bond definition will need to provide some form of substantive credit enhancement in order to qualify as bonds. It may be guarantees, it may be tranching with a residual loss absorption tranche at the bottom of the stack, or it could be over collateralization. But if you had a strict pass-through with no credit enhancement, that would actually no longer be a bond after January 1st, 2025. So just a little forward look in that regard. Next slide, please. Wanted to illustrate what your RBC factors are for a Schedule D bond. And you can see the range from the lowest of a 1A is 158 basis, well, 0.158%. It is pretty good. I mean, that is very comparable to what would be an insured or guaranteed bond. So in a securitization, the tip-top rated tranche, if you can get up that high, is going to be very favored from an RBC standpoint. And if you look at something like an A+, which is 1E, that's 65.7 basis points, very similar to the 68 basis point Schedule B bond charge for a mortgage loan, in a residential mortgage loan in good standing. And then when you get to the lower tranches, first of all, it's a big drop when you get below investment grade, and then in the lower rated tranches, you're looking at pretty high capital charges, and similar to what you might have in the mortgage loans not in good standing on Schedule B. Next slide, please. Okay, so now let's just compare what we have seen so far, and just looking at the different possibilities for how a mortgage loan is treated and reported, and what that means for the risk-based capital factor, and then what is also important to insurance companies, whether they have to mark to market or whether they can carry at the amortized principal. So the Schedule B residential, the RBC factor is tied to, first of all, whether it's insured or guaranteed, but then assuming it's not insured or guaranteed, well, even if it is, the payment status, you remember those three tiers: good standing, more than 90 days overdue, but not in foreclosure, and then in foreclosure. But Schedule B mortgages don't have to be marked to market. Schedule B commercial, their RBC depends on what category they're in, CM1, 2, 3, 4 through 7, and that's going to be determined on a formulaic basis based on debt service coverage and loan to value ratio. Also, being on Schedule B, they don't have to be marked to market. And then Schedule BA mortgages, these are the ones that are held through an intermediate vehicle like a partnership, a joint venture, limited liability company. Their RBC factor is going to generally use the commercial mortgage categories with senior loans at that 1.75% level associated with a CM2 mortgage. Because they're on Schedule BA, they do have to be marked to market, and that's going to be because they're carried at the gap equity value of the intermediate vehicle that holds the underlying mortgages. And then Schedule D, your securitizations or senior loans to a securitization vehicle, that would be what's included in Schedule D. They're going to have a credit quality designation based on modeling for the MBS. And although it's not in this chart, by the credit quality rating from an external NRSRO if it's senior loan, and they are not marked to market as long as they're above that basement level of NAIC 6. Next slide, please. One more aspect of this I wanted to cover, which is that many state insurance codes have the concept of an insurance company owning an investment subsidiary. And the investment subsidiary is a subsidiary of the insurer. And just want to footnote there, to be a subsidiary needs to be controlled by the insurance company. And the sole purpose of an investment subsidiary is to own and manage investments that the insurance company could have owned and managed directly. And when looking at the compliance with the insurance company's limits in the statute, concentration limits, aggregate limits on how much can be invested in mortgages, how much can be invested in securities that have a certain below investment grade rating, how much can be invested in obligations of a single issuer. Those are all things that are governed by the insurance authorized investment statutes of the states. But when you're complying with those, you look through the investment subsidiary and aggregate like-kind investments that are made indirectly through investment subsidiaries with the investments that are made directly by the insurance company. So that makes perfect sense. Otherwise, it would be too easy to evade those quantitative limitations. But it's one of the ways in which there is a look through the investment subsidiaries. Now, the practice varies, and this is in quotes, practice varies with regard to how insurance companies actually deal with the investments they make through investment subsidiaries, not just mortgage loan, but any investments they make through investment subsidiaries. But we focused here on the mortgage treatment. So Schedule BA reporting based on the GAAP equity of the investment subsidiary is perhaps the easiest to defend when statutory accountants, internal and external, are looking at investments through investment subsidiaries. Very easy for them to say the investment subsidiary should go on Schedule BA as one of these intermediate entities and have it be reported based on the GAAP equity. And I keep coming back with that number of 1.75%, which is the Schedule BA mortgage factor for underlying senior mortgages. But I am aware that there are insurance companies that are doing a full look through and reporting the underlying mortgages on Schedule B as individual mortgages owned. And then if they do it on that basis, the risk-based capital is going to be calculated based on the factors for Schedule B mortgages with that 68 basis point RBC charge for a residential mortgage in good standing as an example. And the reason why you would do that seems kind of obvious, because it does lead to a 68 instead of 175 basis point RBC charge associated with that. But also I am seeing different practices and different views by the people who have to get comfortable with this treatment at the end of the day, who are the insurance company's own statutory accountants and their external auditors who are looking at their statutory accounting treatment. So I'm just going to leave it there at this point and get ready to pass it on to our next speaker, which I am just going to say is Terry Schiff and Hawker Goodmanson, talking about some of the practical structuring and in some ways also taking off from the things that I've been talking about with the way that investments get treated for insurance companies. So Terry and Hawker, take it away.
Thank you, Larry. Next slide, please, Grace. So we wanted to talk about a couple of pictures that kind of, I think, put in practice a couple of ways or different ways in which, insurance companies can go about addressing, I think, the kind of the two kind of main themes coming out of the presentations we've listened to so far. The first one is the need to obtain state licensing to hold mortgage loans in certain states, and the second one being the ability to determine whether the investment is put on Schedule B or Schedule BA or even, I guess, Schedule D. And so the first, and obviously I'm skipping over the simple structure, which is the insurance company just buys the mortgage loans and holds it directly, either by obtaining and maintaining licenses or investing only in states where they have exemptions in insurance companies or licenses are not otherwise required. And I want to focus on these couple of different trust structures that are based on the premise, as Steve noted, that if the loans are held by an entity that is a nationally or federally chartered institution, presumably the federal preemption and the various state licensing exemptions that apply to federally chartered institutions would apply. And so this structure here that we call pass-through trust is effectively a titling trust. I think Larry referred to it. And the idea is that the insurance company will form a trust. It can either be a Delaware statutory trust or a New York common law trust. And the idea is that the Delaware Statutory Trust Act expressly provides the legal title to assets that belong to the trust can be held in the name of the trustee on behalf of the trust. And if the trustee of the trust is a nationally chartered institution, the idea is that the argument is that that entity that is holding legal title to the loans has the benefit of the federal preemption and those state level exclusion. In this simple structure here, the trust will acquire loans from third-party sellers, and ideally the MLPA, the mortgage loan purchase and sale agreement, will provide that the legal title to the assets is acquired by the trustee, not as an individual capacity, but as trustee of the trust. The trustee on behalf of the trust will also engage the servicer to service the loan, whether it's the seller or a different third-party servicer. And that's kind of important because, as Steve noted, in certain states, the ability to direct the servicing of the loans in itself is a licensable activity. And in this picture, what the insurance company holds is a trust certificate. And so that, I think, it gets a little bit relevant as to how that investment is going to be categorized under the statutory accounting, whether it goes on Schedule B or Schedule BA. And Larry talked about the differences there. And I think, and as we'll see on the next slide, if the idea, I think, would be in order to facilitate hopefully getting to a Schedule B conclusion, I think it would be a good idea to frame this trust certificate as closely as possible to how a participation certificate would look. In other words, having some language in the trust agreement that states that the trust certificate represents 100% of the beneficial ownership interest in each of the mortgage loans that are held in the trust, which I think will kind of provide a connection with the language in SEP 37 that talks about the bulk purchase versus the bundle of loans. And I think, depending, of course, like Larry noted, on the view of the statutory accountants, the hope would be in this structure you would get Schedule B treatment rather than the Schedule BA treatment, which I think is probably pretty clearly the favored outcome. Next slide, please. And to illustrate this point, here's an alternative structure that looks identical to the other one, except that the trust will issue two items to the insurance company. They'll issue a trust certificate that represents effectively kind of the ownership of the trust itself. And then a participation certificate pursuant to which the trust will sell 100% participation, a participation interest in 100% of the beneficial interest in the mortgage loans. And I think the idea here is, to the extent that there is reluctance or an issue with getting to the Schedule B treatment with option number one, here you have a participation certificate that is more clearly contemplated by the express language of the of SEP 37 that Larry was talking about earlier. Now, Tamim is going to talk in a minute about some complications relating to the potential home loan bank financing, to the extent relevant with this structure over compared to structure number one. But I kind of note here that, I think that these are, functionally equivalent or economically equivalent. Next slide, please. I'm not going to go over this one, except just I put it here to kind of note that there's a lot of different ways to do this, and here is kind of a more complicated approach. This is something that might work well for affiliated insurance companies that want to share and create kind of a combined acquisition platform. Here we have a titling trust that consists of multiple series. The idea is that mortgage loans would be acquired into the trust. The trust would be the Delaware Statutory Trust Act again allows you to specify on the books and records or allocate on the books and records particular assets and liabilities to a particular series. And here you would effectively allocate, you would buy all the loans into a single trust, allocate on the books and records of the trust to a particular series, and each insurance company would own its own series, and the series would either issue trust or what we call SUBI certificates or participation certificates, depending on the accounting preference. And it's a pretty efficient way to allocate loans without having to record title in the local real estate records. Next slide, please. And I'm now going to turn it over to Terry Schiff to talk a little bit about, a few kind of practical considerations in setting up a residential whole loan kind of acquisition program.
Thanks, Hocker. So what we're looking to do here maybe on this slide is, if we step back to a much higher level, what Hocker spent a bit of time focusing on, and what some of my partners have spent time on, is what are the structures at the purchaser? Do they hold the loans directly? Do they hold the loans indirectly through one or more subsidiaries? What this slide is stepping back a little bit and saying, as you practically build, as an insurance company practically builds a whole loan, a residential whole loan program, there's perhaps more, but there's probably 5 principal parties that are included in the program. Obviously, there's the purchaser. There's also, the seller that actually sells the assets. There's the servicer, right, that services the assets, collects the payments and remits the net payments to the purchaser. And then there's the custodian that holds the files, the physical files. So part of practically what we think about as we build these programs is, with respect to each one of those 5 entities, what are some of the real practical considerations in terms of determining the identities of those parties and then setting up the relationship with those parties? Hocker just finished spending a bit of time on the purchaser, whether you would hold directly as the insurance company, whether you would hold indirectly through a trust, and whether that trust perhaps even is indirectly owned by the purchaser through an LLC or some entity like that. But then we kind of think about the seller. And obviously, identifying a seller in the program is probably the first step, because that's the entity that sources the collateral, the residential mortgage loans that are purchased. But even thinking through, well, what would be an appropriate seller to identify? At least a couple practical things come to mind. One would at least to me, I think about is volume. What types of volume does that seller originate the assets or acquire assets that then would be sold to the insurance company directly or indirectly? Also, what types of products does the seller source? Would those be non-QMs? Would they be business purpose loans? Would they be qualified mortgage loans? Things as the insurance company is developing the program, what types of assets would they be looking to acquire? Then I think a little bit about the servicer. So the servicer is also thought of a bit along the lines of considering the seller, because in lots of programs, the sellers of the assets will have servicing capabilities. Sometimes they won't, or sometimes the insurance company would want to use, a separate servicer that they would like to do business with. And in those cases, we think a little bit about, have they worked with the seller before? If it is the seller, obviously there's no transitioning or transfer of servicing. But if there is a transfer of servicing, have they worked together before, and how would that transfer occur? The next thing we think about is a custodian. The custodian's role, right, is roughly, as the slide sets out, to basically hold the physical collateral that is actually makes up the mortgage loans. And that collateral, as we think about choosing a custodian, there's often or always, almost always, physical collateral that's held in some sort of vault by the custodian. And then oftentimes it may be important for the insurance company to also have its custodian hold electronic copies of documents. So that would be a consideration. And then in terms of the bailee that's noted here, the bailee is in essence the entity that assists the transfer of the physical collateral from the seller's custodian to the purchaser's custodian. And that would be put in place such that the collateral is transferred on or before the closing date or after the closing date. And then perhaps maybe, another note or a final note to think about as, as we think through building a residential mortgage loan program is how many. I mean, it might sound like an easy thing to think about, but programs can range from a single seller that services the assets with one separate custodian and a bailee that assists in the transfer, and that's it. Programs also can consist of many sellers with multiple servicers and multiple custodians. So even though as a program begins to launch, or as you begin to do your first transaction, it's often good to also keep in mind at a higher level what is basically the projected size of the program, and how do the numbers of entities fit in with those. So I think next, Tamim was going to talk, as Hocker noted, a little bit about federal home loan bank financing.
Thanks, Terry. Next slide, please. Okay, so hi, everybody. My name is Tamim Zenelbai, and I'm a partner in the Chicago office of Mayor Brown, and I work in the banking and finance group. I'm going to give a short overview on how insurance companies obtain FHLB financing for residential mortgage loans. But before I start, one thing that's kind of top of mind right now is that the FHFA, which has ultimate authority over the FHLBs, has been conducting over the course of the past year a top-down review of kind of the entire FHLB system. And we've been following this review very closely and believe that it's expected that the report from the FHFA is going to be released kind of any day now, imminently in the next few weeks. And, we're not entirely sure, no, I don't think anybody is, what to expect in the report as it relates specifically to this topic, which is financing residential mortgage loans with the FHLBs. But, as soon as the report comes out, we will jump on it, and you can always look to Mayor Brown to provide kind of an overview and analysis when that report comes out. But as a result, some of the things that I'm going to talk about just now could change once that report comes out. But as of now, as it stands now, since mortgage loans are typically held in the structures described by Hocker as a result of some of the state mortgage licensing considerations, among other things that Steve and Holly talked about, we have seen we have seen insurance companies finance residential mortgage loans in kind of one of the three ways that are listed below on this slide. And so the first and simplest is if the member insurance company owns the loans directly and pledges them directly to the FHLB. Now, this structure is rare, as Hocker noted earlier, mainly because that would require the member to obtain the requisite licensing in order to own and hold those mortgage loans, and we typically don't see that. Much more popular and common is the second structure, which is when the mortgage loans are held directly in a trust. The trust can then pledge those loans directly to the FHLB as security for the member insurance company borrowing against those assets. And we typically refer to any time an affiliate of the insurance company, the trust, namely the trust, pledging loans as an affiliate pledge. And that's a very common way for insurance companies to obtain financing backed by these residential mortgage loans. The third way is similar, but the insurance company would pledge a participation certificate that it has, and that represents the economic and beneficial interest in a pool of loans that are held in a trust. And there simultaneously, the trust itself would pledge those mortgage loans to the FHLB in connection with obtaining financing from the FHLB. So those are the three kind of common ways that we've seen, particularly when it comes to an affiliate pledge. Next slide, please. So one thing that's been top of mind for the FHLBs, and we've seen that they've been focused on it since 2021, is a FHFA regulatory interpretation that came out in 2021 and discussed participations as collateral for FHLB advances, the participations being participations in mortgage loans. We view that there are fundamental factual differences between this regulatory interpretation and the structures that we described in the previous slide and the pledging of loans to the FHLB. The biggest and most important factual difference is that in the structures we described, the mortgage loans were pledged directly to the FHLB instead of just a participation interest in the loans. The main focus point we've seen for the FHLBs coming out of this regulatory interpretation, based on our experience, has been to ensure that there are no impediments to liquidation or foreclosure of the underlying collateral held by the FHLB. And they're looking for easy and effective and quick ways to be able to realize on the collateral. And the structures described in the previous slide accommodate that concern. Next slide, please. Finally, the third thing that we always make sure to think about when entering into a financing arrangement with the FHLBs backed by residential mortgage loan holdings of insurance companies is what the custodial arrangement will be. And Terry alluded to setting up a custodial arrangement for the program in general. And then, as similar to many other lenders in this space, the FHLB also requires some level of privity with a custodian who holds the underlying mortgage files. And we've seen it come in different flavors, but it's either a new agreement, custodial agreement, that's between the FHLB, the borrower, and the custodian, or some form of side letter that acknowledges that the FHLB has rights to the collateral pursuant to this arrangement. Those are all the kind of salient topics we wanted to talk about when it comes to FHLB financing. And now I turn it over to my colleagues, Claire and Adam. Thank you.
Hi, I'm Claire Reagan. I'm a partner in the finance group who focuses on fund formation. I represent both sponsors and insurance institutional investors investing in a wide variety of investment products into a wide variety of assets, including insurance companies into mortgage loans. And now that we're an hour and 12 minutes into our presentation, I'm sure if we've taken nothing away from this, there's a lot of regulatory and licensing concerns and considerations that go into investing into mortgage loans. So if you're an insurance company looking to invest in mortgage loans, one of the best things you can do is pair up with an asset manager whose business it is to do that, and knows all those rules and regulations, and has experience and opportunities to source investments and to manage them. So we're going to talk a little bit about some of the considerations that are applicable to asset managers in the space. So really, when you're from the asset manager's perspective, offering an investment product to invest in mortgage loans doesn't look that much different from the investment products that you can offer to investors to invest in sort of any type of investment class. And it is really a huge range of products that can be offered to structure the investor's needs. I mean, on the one end, we can start with a commingled fund, which is obviously gone out and the investment manager puts together a product marketed to a bunch of investors, which may or may not include insurance companies. And on the other end, you might have one insurance company coming to an asset manager saying, hey, I want to invest in a dedicated pool of mortgage loans and I want you to manage it for me. So, and you've got also everything else in between, you know, club deals, joint ventures, whatever. So when you're thinking about it, I guess from the investor perspective, well, I guess from both perspectives, regardless of where you fall on the spectrum, whatever investment product you put together is probably going to have a few common characteristics, which is there's probably going to be a pool of committed capital so that the investment manager knows how much money it has to go out and acquire investments. There's going to be some sort of investment period where you're going to go out and make investments, and then there's going to be a harvesting period where you wait for those investment returns to come in. So those are similarities between sort of any product that you get into. On the commingled investment side, if you're an insurance company going into a commingled fund, like any commingled fund, you're not going to have a lot of control either over the investment vehicle or insight into the actual investments being made. On the control point, you'll have some sort of key voting rights, but you're not really going to be able to control anything. You might have the opportunity to remove the investment manager if it's doing something it doesn't like, but your vote is just going to go into a vote with the rest of the investors. So no single investor is likely to control anything in a commingled investment vehicle. And also on the investment to be made, the investors aren't really going to have any control. There's a lot of discretion for the asset manager to choose the investment that it feels is correct for the vehicle. The vehicle will probably have been marketed with sort of investment criteria and probably even some investment restrictions, but they're going to be fairly high level. You will probably have, sort of geographic restrictions for the mortgage loans to be made. You'll probably have concentration limits, things like that. But within those buckets, the investment manager can kind of make the investments that it sees fit to do. Conversely, like in a separate account, generally, you can expect that the investor is going to have more control both over what happens with if it's a vehicle or even under certain rights relating to the sort of investment program, and control and even approval over the actual investments made. In an SMA, there's certain exceptions to this. Sometimes an investor doesn't want to have control in the US over these things, but sort of as a general rule, I think that is true. And in a separate account arrangements, it's much more likely that the investor is going to have control over things like the servicers that can be used, the form of purchase agreement that the asset manager is going to use if it's acquiring the mortgage loans, things like that. And then probably, unless there's other considerations, it probably may also have control over the actual investments being made. And it depends what the investment program is. Sometimes, if there's going to be made, if the investment program is to make very sizable loans, the investor may actually be fairly involved in a lot of the specifics of making the loans. But if it's sort of smaller dollar investments to be made, there's probably some sort of batching that goes on. There's a tighter buy box for the mortgage loans that can be acquired. Generally, than you would see in a commingled fund, much more specificity about exactly the type of mortgage loans and the borrowers that are going to go into the program. But if they're smaller dollar loans, nobody wants to approve every single one of those if there's a high volume. So there'll be some sort of batching where every few days the asset manager will provide a loan tape to the investor that has the details about the loans, and there'll be an approval in that sense. In terms of structure, we did, Terry and Hocker talked a little bit about structure. They're relevant a little bit more directly in the SMA type context, but some of those considerations are also relevant in a commingled fund structure. Obviously, in an SMA context, you can be a lot more bespoke for the particular needs of the investor that's involved. In a commingled fund, like most private equity funds, generally the default position is you're going to probably be a Delaware limited partnership, but then the asset manager will have all sorts of other tools to kind of, feeder funds and parallel funds and other things that they can bring into the structure to kind of meet the investor's needs. And then, of course, the main thing driving that generally is, I think we like to say, optimizing tax efficiency for the investors. So I think we could do another program on tax considerations relating to investing in mortgage loans by insurance companies. So I won't get too much into it, but just as sort of an example, if it could be very efficient for an insurance company, a US insurance company, to use an offshore affiliate to invest in the mortgage loans. But that's only true if they're not doing origination activities. So it's loan acquisition, because then you're trying to minimize or avoid the amount of US tax to be paid. And if you get into things like origination activities or workout situations or foreclosure, which I think are particularly relevant in our current climate, you may have to put in other sort of structures to kind of deal with those issues as well. So a variety of structures can be used regardless of what the overall investment program is. But I think another thing we can say that no matter what, the variety that you can enter into the investment arrangements for people wanting to invest in investment or in mortgage loans, one thing they're definitely all going to have in common is that the asset manager is going to want to be paid for the work that it does. So I think in that space, again, there's always some variation depending on the negotiation power of the parties involved and the specifics of the transaction. But you can expect to see some sort of management fees, which is just a periodic, keep the lights on type fee that the investment manager will get throughout the life of the fund. And in the mortgage loan space, I think it's most common to see it as some sort of percentage of invested capital. Unlike like a buyout fund where sometimes there's a percentage of committed capital through an investment period, pretty typically it's a percentage of invested capital from day one, which then the formulation stays the same throughout the life of the fund. Obviously, the actual dollar amounts that management fee are going to vary based on the amount of invested capital at any particular time. And that management fee is really for managing either, if you formed a vehicle, either it's a commingled fund or it's a fund of one, or you just form sort of an SPE to do it, or under the IMA. And that is separate and apart from any sort of origination or sourcing fees that the investment manager might also take, and any servicing fees, which may be done by an affiliate of the asset manager or someone else. So this is above and beyond those deal level fees. And then it's also very common to see some sort of performance compensation for the asset manager, depending on the performance of the portfolio. And again, a lot of variety can go in there, but fairly typically it's structured as a typical carried interest or incentive fee, where the asset manager is going to get a percentage of the profits, 10 to 20% above generally some sort of agreed upon hurdle. So that's one thing all will have in common is the investment manager getting paid. So, and I started off talking about the complexity and regulation. And And when you introduce an asset manager, it of course adds another level of regulation. So I'm going to turn it over to my colleague, Adam Cantor, who can talk a little bit about the considerations applicable to regulatory considerations applicable to asset managers.
All right, thanks, Claire. So hi, everyone. I'm Adam Cantor. I'm a partner in our investment management group in DC, and going to talk a little bit about, as Claire just said, two of the regulations that really apply when you introduce asset managers into the structure, both from the perspective of the fund or entity that's being created, as well as the asset manager itself. So anytime we have an entity that's investing in securities, we have to worry about the Investment Company Act of 1940. And you may be asking, well, Adam, why do we care about securities? We're talking about mortgages here. And if you were listening to Larry earlier talking about the RBC related to, what is a mortgage, it said, oh, well, it's got to be something that isn't a security. Well, unfortunately for our purposes, under the 40 Act, we do consider mortgages to be securities. And that's different from how we think about things under the Securities Act of 1933 or the Securities Exchange Act of 1934. But in our little world of the 40 Acts, we consider mortgages to be securities. And so we do have to wrestle with the Investment Company Act of 1940. The statute defines an investment company in two ways that really matter. One is an issuer that is primarily engaged in the business of investing in securities, and the other is an issuer that invests 40% or more of its assets in investment securities. So generally speaking, anytime we're creating a fund to invest in mortgages, we're going to come within that threshold definition of, is it an investment company? Yes, it is. Now, never fear, that doesn't mean that we're going to turn all of those funds that Claire was talking about into mutual funds or registered investment companies. We have a few very reliable exceptions we can turn to. The first two have some hair on them that I'll talk about in a second, and that's Section 3C1 and Section 3C7. We do often refer to them by these statutory numbers for ease of reference. These are funds that conduct private offerings and either have fewer than 100 investors or are sold only to qualified purchasers. That's generally a $5 million in investments or $25 million in investment standard, depending on whether you're talking about natural persons or entities. We also have Section 3C5C under the Investment Company Act. That's another separate exception for issuers that do not issue redeemable securities and can satisfy certain asset thresholds. Generally speaking, we need at least 55% of the assets of the issuer to be in what we call qualifying real estate, right? So that's essentially first mortgages, certain types of second mortgages, certain types of mezz, certain, A notes and B notes. It's very specific as to whether it qualifies in that 55% bucket. We then have a 25% bucket of other real estate related securities. And then the last 20% is essentially anything goes. And as I said, it also can't issue redeemable securities. So you essentially can't set up something that looks like a mutual fund and try to cram it into the 3C5C exception. But you can have some amount of redeemability as long as we sort of satisfy, and there is a great deal of SEC staff lore, L-O-R-E, rather than law, L-A-W, on what constitutes a redeemable security. And there are ways you can have some repurchase functions without actually tripping over the redeemable security issue, but it is a very complex analysis. And so a lot of funds do simply default to 3C1 and 3C7, particularly if they are of the open-ended nature, 3C7 really more than 3C1. But for closed-end products, 3C5C is a great option, again, assuming that the actual investments you're making qualify under those tests. On the other hand, using Section 3C1 and 3C7, as I'll talk about in just a minute, have some issues with them because of the kind of very prolific rulemaking and enforcement environment we find ourselves in with the SEC. So let's go forward one slide and talk a little bit about the other side of the 40 Acts, which is the Investment Advisors Act of 1940. So again, because mortgages are securities for our little purposes of our tiny little fiefdom here, we do consider someone to be advising regarding investments in those mortgages to be an investment advisor. They are providing advice about investing in mortgages for compensation. So the Advisors Act itself, there's a general registration obligation. There are a number of exemptions. Most of those will not apply to most of the people that we talk about who are investing in the mortgage space, especially on behalf of large institutional investors like insurance companies. With one little caveat that I'll just mention, which is there's actually an exemption under the Advisors Act for an advisor whose sole clients are insurance companies. So the insurance space is a somewhat unique area where some insurance specialized managers whose only clients are insurance companies actually do qualify for an exemption from registration. But as to everyone else, they are registered for the most part. Now, the Advisors Act imposes a host of substantive requirements on advisors. I'll touch on one quickly just because it is kind of, it has sort of an interesting application in the mortgage space, which is principal transactions. So one of the specific requirements under the Advisors Act is that if the advisor is engaged in a principal transaction, meaning the advisor is selling as principal or buying as principal on one side with the client on the other side of the transaction, that requires the client to give consent to the transaction. So how does this come up? Well, if the advisor is affiliated with the originator of the mortgage and is selling the mortgage from the originator to the client, that is a principal transaction. So that has to be done with client consent. And under the Advisors Act, that consent must be provided on a transaction by transaction basis. You can't simply provide a blanket consent at the beginning and say, all mortgages, executed on these terms are kind of pre-consented to. You do need transaction by transaction consent. Claire mentioned a couple minutes ago that oftentimes we see things are done in batches, and that is one way to sort of address, particularly for advisors that have affiliated mortgage originators, doing it as part of a batch process, and to the extent necessary, getting consent all at one time is a good way to address that. There are a bunch of other requirements under the Advisors Act as well, especially that apply to registered advisors. These include safekeeping and custody of client assets. I'll put a little asterisk on that because the SEC earlier this year proposed to amend the custody rule, which is a thorn in the side of almost every registered advisor, to make it even worse, if you can imagine that. So that's going to be something that will probably get finalized early next year, and we look forward to dealing with all of the horrible implications of that in the years to come. And there are other requirements as well. Another one that I'll touch on rather quickly is you may have seen in the news over the past couple months, in September or really late August, the SEC finalized the rather long-awaited private fund advisor rules, which impose a number of significant new obligations on advisors to those 3C1 and 3C7 funds. They do not apply to the funds that rely on Section 3C5C, but for those 3C1, 3C7 funds, those are private funds, as we call them, and they are subject to a host of new requirements under these set of rules that were just adopted. These include new significant reporting obligations, new requirements related to advisor-led secondaries, as we call them, new obligations related to certain types of expenses being passed through, and a whole host of new requirements related to preferential treatment or side letters. There is a lot to unpack as part of that rulemaking. It's definitely going to have implications on the private fund industry writ large, but no less impacting the mortgage space in particular. So I'm going to turn it over to our next speakers. So it's going to be Eric Riley, David Freed, and Biller Smith.
Hey, good afternoon. This is Eric Riley. I'm a partner in the banking and finance practice based in Charlotte, North Carolina. We can go to the next slide here. A couple of speakers ago, Larry Hamilton noted that it's not always clear the distinction between a commercial mortgage and a residential mortgage. It's very important for risk-based capital purposes because on balance, generally, a residential mortgage will get better risk-based capital treatment. So one thing we look to often is how the investment is classified for statutory accounting purposes, and that is the regime that is applicable to insurance companies rather than GAAP, which is applicable to most other entities. So what factors do you need to consider when you're looking to see if it's a commercial mortgage or it's a residential mortgage? You kind of start with, is it a residence? Does someone live there? Is it an individual that earns some type of income, and that is what the loan repayment is going to be based on? Do they have a FICO score? Or on the opposite end of the spectrum, is it an entity that's a borrower? Is it an SPE? Is it owned by an entity or individuals that are in the business of making these types of borrowings? And is the repayment of the loan based not principally on the individual's income unrelated to the property, but based on the expected income streams related to the property? Are there tenant leases? Is it an office building? What type of area is it located in? Those type of things are very important. Is the loan recourse? Is it non-recourse? And how many units is it? It's pretty obvious that if you have a 200-unit apartment building that is rented out and it's owned by an SPE borrower, that's going to be a commercial mortgage loan. A little bit different if it's 5 families generally, and the agency rules look to a residence or residential mortgage loan to be 1 to 4 family. So these things are important for risk-based capital and also for licensing and other approvals. You don't want to necessarily invest in something that's described as a mortgage loan or described as a commercial loan, but it's actually something else. If the person that originated that loan didn't have the proper licenses, there could be significant issues with respect to residential mortgage loans. Also, if you're talking about agency product and that person that you're investing in or buying those loans from doesn't have the approved mortgagee status that you need, you may not be able to avail yourself of certain insurances and the like that are available from the FHA. So a very important item to keep in mind and also to look for when investing in mortgage loans, how the originator of those loans is characterizing them and how they're making that characterization and whether you're comfortable with it. Next, Miller Smith is going to talk about some specific investment opportunities with respect to commercial mortgage loans.
Thanks, Eric. Next slide, please, Grace. Hi, everyone. My name's Miller Smith. I'm a partner in the banking and finance group in Mayor Brown's Charlotte office. And I'm going to speak today about 2 commercial mortgage loan financing structures that we see in the market that tend to be attractive to insurance companies looking to invest in commercial mortgage loans. Both of these structures provide the borrower that holds 1 or more loans with leverage, and these tend to be attractive to insurance companies for a couple different reasons, including insurance companies that may be acting as a syndicate lender as opposed to a sole direct lender. First, deals that use these structures tend to be collateralized by a static pool of assets, as opposed to a revolving facility where new loans are being pledged continuously throughout the life of the deal, which requires ongoing review and diligence, additional approvals, et cetera. Second, and probably most importantly, these facilities may be rated such that the RBC charges to the insurance company that Larry spoke about earlier may be reduced, which is obviously attractive. And sometimes this rating is a critical sort of threshold feature of the deal. So first we have non-mark-to-market repurchase facilities. These deals use a traditional repo structure governed by a master repurchase agreement, which is very common in the CRE loan financing space. The non-mark-to-market feature is very attractive to borrowers or repo sellers, whereas in a traditional repo financing, the lender or repo buyer is able to issue a margin call and require a pay down of their advance to the extent the value of the asset deteriorates. In these deals, there are no such margin rights, and instead there are certain portfolio tests like debt yield or loan to value, and the failure of which will require a mandatory prepayment. These facilities do tend to have higher pricing, may not be available to certain counterparties depending on the credit quality of the counterparty and the underlying assets. And we've seen similar structures that just use a traditional loan and security agreement instead of a repo. That's usually just based on lender preference and some other bankruptcy safe harbor considerations. Next slide, please. And next we have private or single investor CRE CLOs. This is another non-mark-to-market structure typically used to finance static pools. Although sometimes we do see facilities with a ramp period during which additional loans can be added to the facility. These deals are sometimes structured with just a single indenture and credit agreement, perhaps a separate credit agreement indenture, in each case pursuant to which the lender makes a Class A loan to the issuer/borrower. And then the issuer issues a Class B note or perhaps some additional subordinated classes to an affiliated counterparty. And again, in lieu of traditional margin rights, there are loan protection tests, including interest coverage or par value tests, failure of which results in adjustment to the priority of payments. Advance rates on these deals are usually a little bit lower than traditional warehouse financing, pricing a little bit higher depending on the credit quality of the assets and the counterparty again. Next slide, please. But repurchases are typically limited to material rep breaches, document defects, and other specified events. And the affiliated note holder may have certain consent rights or purchase options for certain agreed triggers. And as I mentioned, we also see insurance companies buying into these deals as syndicate partners post-closing. Syndication is not as common in this space as you might see in the direct CRE lending market, but it's been increasing somewhat over the last few years as bank lenders are looking to transfer exposure for various reasons, and as insurance companies have looked to deploy capital in this space. But because these warehouse facilities have not traditionally been structured for syndication, the process can take a little bit of time as we've seen parties sort of sort out like co-lender and co-buyer rights, including consent to modifications, waivers, defaulted lender provisions, etc. And now I'll turn it over to David Freed to provide just a high-level overview of the state of the CRE CLO market and some commentary on some deals we've seen involving insurance companies.
Thanks, Miller. I'm David Freed. I am a partner in the Capital Markets Group in New York, in Mayor Brown's New York office. And so, as you might expect, CRE CLO issuance has been impacted by rapid increases in benchmark interest rates, widening spreads, global macroeconomic disruption. According to data from Commercial Mortgage Alert for the 9-month period ended September 30th, 2023, CRE CLO issuance volume totaled almost $6 billion, which is down approximately 78.1% from the $27.4 billion that was raised in the prior year period. But despite challenging capital markets conditions, we have seen insurance companies take advantage of opportunities to deploy capital, invest in commercial mortgage loans through some of these single investor private CRE CLO structures. For example, in the third quarter of 2023, Lumen Finance Trust, which is an externally managed commercial mortgage REIT, closed a $386 million non-recourse match-funded, non-mark-to-market financing, and it's collateralized by floating rate transitional mortgage loans that are secured by multifamily properties. All of this has been discussed and disclosed in an 8K that LFT filed with the SEC. The indenture, the credit agreement for the transaction have been filed. So if you want additional details, you're more than welcome to look at the 8K on the SEC's website. But in connection with the financing, LFT obtained $317.7 million of third-party debt capital. An insurance company provided the most senior tranche of the financing in the form of a $270 million Class A senior secured floating rate loan. An affiliate of LFT's external manager provided $47.3 million from the sale of the Class B and the Class C senior secured floating rate notes. The Class A loan and the Class B and C notes priced at a weighted average spread of about 314 basis points over 1 month. So for LFT, a subsidiary of LFT as the issuer retained the remaining portion of the notes of $68.6 million, and that included $35.3 million of unsecured income notes. The transaction is a managed deal and provides for a 24-month reinvestment period, which allows LFT to reinvest principal proceeds from repayments of the collateral in eligible mortgage collateral, subject to certain conditions and eligibility criteria. This is important given the fact that a lot of the deals that we've seen happen in the first 9 months have been primarily static deals, which don't have reinvestment periods. for risk, as Larry had discussed earlier, for risk-based capital purposes, the Class A loan would be treated as a Schedule D asset, would receive its NAIC credit quality designation based on the NRSRO rating that it received. And accordingly, the indenture for the transaction requires the collateral manager to liquidate the collateral and repay the Class A loan with sale proceeds if the Class A loan, if its rating is removed and an investment grade replacement rating is not obtained from another NRSRO. This provision is kind of bespoke specific to the insurance company deal. In a typical 144A Reg S CRE CLO, ratings downgrade wouldn't result in the liquidation of the collateral and the repayment of bonds. Another way to address the risk of the ratings downgrade could be, to pass on to the borrower any increased costs incurred by the life insurer from additional capital required to be held and allow the borrower to pay off the loan voluntarily. I know I went through that pretty quickly because we're over time, and I'm now going to turn it back to Hawker for some concluding remarks.
Thank you, David, and thank you to all our audience and all our presenters. A couple of reminders. As I noted at the outset, we did not have time for Q&A at the end of the presentation. We've received a number of questions on the chat, and we will respond to them separately. To the extent that you have questions or want to discuss any topics related to this webinar, please reach out to one of us or to your other contacts at Mayor Brown, and we'll be happy to discuss further. Thanks, everyone, and goodbye.